is Jeff Whipple, and I'm a graduate student at the University of Oklahoma. I'll be sharing my analysis of investors' use of CAPM during AT&T's acquisition of Dobson Communications. The mega merger of SBC, AT&T, Bell South, and Singular Wireless was completed at the end of 2006. The unified company emerged with the AT&T brand name and effectively reassembled the regional Bell operating companies that were created with the breakup of AT&T back in '82. Following the merger, AT&T went on a historical 10-year acquisition streak in pursuit of three strategies: economies of scale within the U.S. telecommunication industry, entry into foreign telecommunication markets, and diversification of products and services by expanding into other industries. During this 10-year period, AT&T completed 9 of these acquisitions, but failed in their acquisition attempt of rival T-Mobile. One of the acquisitions was of Dobson Communications in 2007. Under the Cellular One brand, Dobson provided wireless services in rural and suburban areas in 17 states. The terms of the acquisition offered Dobson shareholders $13 per share, which at the time was a 16.9% premium. This equated to a $2.8 billion offer from AT&T to be paid in cash. AT&T sought to expand their network coverage by essentially buying Dobson's customers and coverage. And at the same time, AT&T wanted to reduce the roaming charges they paid to Dobson when AT&T customers were in the Dobson geographies. AT&T expected the acquisition to dilute their earnings per share by less than 4 cents in the short term, small amount, while growing free cash flow by $2 billion or over 50% in just 2 years, with the hopes long term that this would increase stock value for shareholders. The deal was signed on June 29th, 2007, and AT&T and Dobson targeted the end of 2007 to close the deal. Acquisition follows a general process consisting of 3 milestones, with each kicking off a new phase. The strategy milestone is when either the buyer or seller has an acquisition strategy in mind and approaches the other party about it. In the case of AT&T and Dobson, their deal, Dobson was the seller and AT&T was the buyer. The buyer and seller then enter discussions and negotiations during the due diligence phase. When the buyer and seller agree upon the terms of the acquisition deal, they enter into a formal agreement at the signing milestone. The signing of their agreement marks the first opportunity for stakeholders to consider or reconsider their interest in the companies in light of the planned acquisition. Prior to that, things are typically kept secret while developing a strategy and working through due diligence. Next, the buyer and seller jointly work through the review phase, during which stakeholders engage to scrutinize the deal. Stakeholders like customers, partners, competitors, regulatory agencies, and investors. The end of the review phase is marked by the closing milestone, when the deal is officially completed and all the terms of the agreement are executed. And for AT&T and Dobson, closing triggered AT&T's purchase of all of Dobson's stock and they assumed all of Dobson's financial responsibilities. As with the signing milestone, this is also an opportunity for stakeholders to consider or reconsider their interest in the combined company. The final phase is the transition phase, and that's when the combined company implements the objectives and goals that were identified all the way up at the strategy milestone. Transition work may span many weeks or months or even years, depending on the degree of change that's needed for the acquisitions strategy to be successful. So a little bit about the stars that are shown here. As I mentioned, the second and third milestones represent opportunities for stakeholders to consider or reconsider their interest in the parties, whether that's the buyer, the seller, or the combined company. The remainder of my analysis, I'll take the perspective of the investors as stakeholders. And specifically, I'll look at investors' typical use of the capital asset planning model, or CAPM, to forecast equity returns and inform their investment decisions at each step along the way. The capital asset pricing model, or CAPM, is an idealized portrayal of how financial markets price securities and thereby determine expected returns on investment. The model provides a methodology for quantifying risk and translating that risk into forecasts of expected return. The model is relatively simple. R bar for the asset is the expected return for the asset. RF is the risk-free return, typically a 10-year treasury yield. R bar M is the return for a market, typically the S&P 500. And beta asset is a coefficient of the asset's relative volatility compared to a market. The CAPM incorporates the influence of systematic risk, or the risk associated with the market as a whole. We can see this in the equation's inclusion of the risk-free rate and return for a market. The CAPM does not account for non-systematic risk, or risk not associated with the whole market. A problem we might face in applying the CAPM to an acquisition is that non-systematic risk is possible because only the buyer and seller and other selected stakeholders are participating in the acquisition and not the whole market. So let's get into the acquisition and the CAPM together. Prior to signing on June 29th, 2007, both companies had experienced nearly a full year of strong returns that more than doubled the market's return. On the signing day, June 29th, 2007, investors would have their first chance to consider or reconsider their future interest in the companies in light of the acquisition. The CAPM would be applied as shown here. RF is based on the 10-year treasury yield 1 year prior on June 29th, 2006, and that stood at 5.2%. R bar M is based on the daily adjusted prices of the S&P 500 for the 1 year prior, which is the period June 29th, 2006 to June 28th, 2007, and that was 20.3%. I say daily adjusted prices because I use the SPY tracker, which gives the daily adjusted price that includes splits, capital gains, and dividends. Made my math a little bit easier. Beta for AT&T for the same 1 year period was calculated to be 0.91. That indicates slightly less volatility than the market, but positively correlated with the market. And the beta for Dobson for the same 1 year period was 1.74, which indicates higher volatility than the market and also positively correlated. Using the CAPM equation, we can calculate the forecasted expected return for the company stocks for the year following the signing milestone. For AT&T, the expected return is 19%, and for Dobson, it's 31.6%. Now, as an investor, you could then use using this information alone, you'd expect that AT&T's return would be slightly under the market return, which was shown here, 20.3%, while Dobson's return would be more than 50% higher than the market return. This information could be incorporated within investors' strategy, their own personal strategy, to inform their investment decision based on their personal investment strategy to buy, to sell, or to hold one or both of these commodities, of these equities. Even though AT&T and Dobson targeted the review phase to complete and the closing milestone to occur by end of the year 2007, which was only 7 months away at the time, the actual duration was only 5 months. So despite the investors' expected a 1 year investment holding period, they're forced to reevaluate the performance of their investment decision after only 5 months. For Dobson, the CAPM forecasted expected return at 31.6% after holding 1 year. Shown here is that return calculated to 12.1% at the end of the five-month review phase. Actual return for Dobson was 16.5%, exceeding the CAPM's forecast. However, looking at the shape of Dobson's actual return line, it seems like much of the growth occurred in the first few days following the signing. Furthermore, the remainder of Dobson's return line in the 5 months following signing doesn't seem to correlate at all with the market line, shown in gray. One potential explanation for this is that investors drove Dobson stock up to the negotiated deal price, then essentially stopped treating Dobson like a market participant. AT&T's actual return line is significantly different shape than Dobson's. AT&T underperformed the market in the days following the signing, presumably to extract value from AT&T, to counteract the higher value of Dobson and restore balance in the market. After balance was restored and Dobson was treated like a non-participant in the market, that left AT&T as the only remaining acquisition participant still in the market, and they bore the burden of following the market return for the rest of the period. This implies that the signing was an introduction of non-systematic risk for a short period of time up front here, after which the remaining market participant, AT&T, experienced very little non-systematic risk. And with a beta of 0.91, AT&T had volatility nearly matching the market. So let's talk more about how AT&T and Dobson actual returns counteracted each other. Going back in time, with a little more analysis at signing, an investor could have calculated the forecasted return for a portfolio that was equally weighted between AT&T and Dobson. AT&T's market cap a year before signing was $23.6 billion, or a weight of 94.8%. Dobson's market cap a year before signing was $1.3 billion, or a weight of 5.2%. The beta for the entire portfolio is the weighted total of beta for AT&T and beta for Dobson, and that comes out to be 0.95. And the expected return for the entire portfolio, that includes both AT&T and Dobson, is 19.6 annually. The forecasted expected return on the portfolio after 1 year was 19.6, but can be calculated at 7.5% at the end of the 5-month review phase, shown here with the little star. The actual return of this portfolio would have been the average of 16.5% for Dobson at the top and negative 2.9% for AT&T at the bottom, which comes out to 6.8%. That's very close to the 7.5 that CAPM would have predicted when calculated on a portfolio. Also of note here in this chart is market performance, way down here at negative 2.8% during the review phase, which is way below the 20.3% we used in the CAPM. Unfortunately, the beginning of the great financial crisis of 2007 to 2008 coincided with the signing and the beginning of the review phase, and had a significant negative impact in the market at the same time. On closing day, November 16th, 2007, investors would again have been prompted to consider or reconsider their future interests in the companies, specifically in the new combined company. And again, they could apply the CAPM to inform their investment decisions. Risk-free rate based on the 10-year Treasury yield 1 year prior to closing was down to 4.7%. The expected market return based on S&P 500 for the 1 year period prior to closing was much reduced, down to 5.6%. Beta for AT&T for the same 1 year period was 0.97, which again indicated almost the same volatility as the market and positively correlated. And the beta for Dobson for the same 1 year period was significantly reduced to 0.67, which indicates lower volatility due to essentially exiting the market shortly after the signing. After closing, the separate companies would cease to exist, and a new combined company would emerge. Again, a portfolio approach could be used to forecast the expected return of the combined company. AT&T's market cap a year before closing was $28.1 billion, with a weight of 95.1%. Dobson's market cap at the same time was $1.5 billion, with a weight of 4.9. Calculating the weighted total of the two betas to come up with a beta of the portfolio came out to be the exact same 0.95. That beta for the portfolio now at closing is the same as it was back at signing. It's 0.95, indicating that investors were treating the companies as a combined asset all the way up at signing and not just later at closing. Finally, the forecasted expected return for the combined company can be computed. That expected return for the portfolio for investments in both AT&T and Dobson is 5.6% annually. So using this information alone, an investor would expect that the combined company's return of 5.6% to be the same as the market return, 5.6%, shown up at the top. One possible explanation is that investors over the previous year have been dubious of the acquisition, ultimately meeting the goal of increasing shareholder value. And those investors prefer to wait until the combined company has a track record of its own to see if it will move differently than the market. This information could be incorporated with an investor's investment strategy to inform their investment decision at closing to buy, sell, or hold their positions in the original companies, and to buy, and as those existing holdings are converted into the combined company, the single holding, or they could buy, going forward, they could buy the combined company stock. And finally, we get to the transition phase. The combined company retained AT&T stock ticker on the New York Stock Exchange of T, while the Dobson company's ticker on the NASDAQ of DCEL was deactivated. Now, the CAPM forecasted expected return for the combined company at 5.6% after holding 1 year. Actual return was negative 25.5%, which seems like a horrendous miss. But recall that the beta of the portfolio representing the combined company was 0.95, a nearly perfect match in volatility with the market. And the shape of the company's, the combined company's return line closely follows the market as expected. The most likely reason for the negative actual return of both the market and the combined company was the systematic risk introduced by the Great Financial Crisis that by this time was in full force. In conclusion, I found that the CAPM was a reliable tool when used to forecast expected returns of acquisition participants in the post-signing review and transition phases, but only when the participant's stock was treated as a weighted portfolio to counteract the seller's early virtual exit from the market. This exit phenomenon, coupled with a premium paid on the seller's pre-signing stock price, could provide investors with opportunities for a quick long call on the seller stock on signing day. And the arbitrage that occurs after signing to normalize the portfolio of the buyer and the seller could provide a long put opportunity on the buyer's stock if a quick contract and a reasonable strike price is available. The analysis also reaffirmed the fact that forecasted expected returns are still susceptible to systematic risks that are inherent in the market. Um, the betas calculated by the CAPM seem to hold true in the shape of the actual return lines in the next period. But the forecasted expected return values did not. I think a few adjustments could be made to improve the quality of the analysis that was completed. Um, I think use of a 1-year treasury as a risk-free rate would be better to match the term of the investment analysis in the holding period. The market index that matches up to the stock being analyzed would be a better approach. Say using the NASDAQ index for NASDAQ stocks or the New York Stock Exchange index for NYSE stocks. I'd also like to see how Fama and French's 3-factor and 5-factor model might be used as a better alternative than CAPM. And I'd like to consider how acquisition was financed with equity or debt, and compute the beta is influenced by the debt equity ratio. But overall, I really enjoyed this project, learned quite a bit, and I look forward to continuing my learning and research going forward. Thank you very much.